Hi everyone, my name is Sang Lee and I'm the CEO and founder of Dark Matter, a technology platform providing enhanced capital connectivity between issuers and investors in the alternative investment space. We help investors better discover and access alternative investment opportunities such as venture capital funds, private equity, and hedge funds. Today we'll go over 6 questions that investors should ask themselves before investing in a hedge fund. These 6 questions can be used as a general roadmap and only touches the surface of more detailed questions that should be asked when conducting due diligence. The first question that an investor needs to ask himself or herself is whether he or she really understands the risks associated with investing in hedge funds. Investing in hedge funds may not be for everyone, and it depends on an investor's risk appetite. Investors should be aware of this very fundamental lesson in alternative investing, as well as all other investments, that returns are not guaranteed. There is always risk involved. Since each fund has a different function and structure, investors should understand the various risk profiles. Risk and returns are typically highly correlated, so investments with the highest potential returns are usually those that have the highest risk. As investors, it's very important to know your risk-return profile or how much you're willing to risk losing to potentially reap outsized gains. Understanding that you may lose most or all of your investment is a key emotional and mental consideration. The second question investors should ask themselves is if they are aware of how hedge fund fees are structured. Hedge fund fees can range from very simple to highly complex. Generally speaking, the more aligned the hedge fund terms are with the interests of its underlying investors, the better for both parties. Investors should also understand if there's a hurdle rate and what the redemption terms are, because subtleties in these terms can mean significant differences in net returns and liquidity. Typically, a standard hedge fund fee structure is a 2-20 model, where the asset management fee is 2% and the carried interest is 20% of the investment profits. Hurdle rates and redemption terms may vary from hedge fund to hedge fund. The next question investors should ask themselves is if they understand how the assets under management are valued. While not generally typical, hedge funds do have the flexibility to hold assets that are illiquid. As a result, the underlying assets may be difficult to value since, unlike stocks and bonds, they do not have a widely available daily opening and closing price. It's critical for investors to recognize and understand that there's some gray area to valuation in hedge funds that participate in liquid assets. Understanding the investment thesis of a particular hedge fund, in addition to the methodology for valuation, is critical for investors. It's critical that investors perform in-depth background research on the hedge fund manager and firm. Are there any SEC violations or pending infractions? A good resource is FINRA's Broker Check for a quick search on the manager. Understanding the manager or firm's track record is also important. Moreover, is the fund run by an emerging manager with little or no track record or an established industry veteran? Investors must understand that there are pros and cons to both emerging as well as more established managers. Hedge funds apply various strategies, from event-driven, relative value arbitrage, quantitative, to multi-strategy, and many more. Therefore, it's important for investors to at least understand the general strategic thesis of the fund. For example, investors may not fully understand the algorithms behind a systematic trading hedge fund opportunity. However, they should have a general understanding of how these funds generally behave. Leave the fund management to professionals and quant trading to computers. It's an investor's job to be fully aware of the tendencies and trading characteristics that are inherently behind the various hedge fund strategies. Beyond these questions of key considerations, all investors should have a strong familiarity with the hedge fund due diligence process. A good resource for investors is the industry standard due diligence questionnaire provided by the Alternative Investment Management Association. Investors should vet the brokerage firm and other third-party fund administrators that the hedge fund is working with in order to understand whether or not the fund is engaging with top-notch industry professionals. Face-to-face meetings or phone calls with the hedge fund managers is also helpful to discuss track record, strategy, and how the fund differentiates itself, which often extends beyond quantitative measures. Please remember that these 6 questions only touch the surface of the more detailed questions that should be asked related to specific due diligence. There is no single correct formula or silver bullet for deciding on a hedge fund investment. Thanks for watching our overview for new investors interested in hedge funds. Don't hesitate to contact us if you have any questions regarding hedge fund investments. You can visit us at www.darkmatter.com to discover alternative investment opportunities and access our proprietary content on our blog. Connect with us on Facebook, LinkedIn, and Twitter to keep up to date on new alternative opportunities. Thanks for your time.